You're listening to HECM World Weekly, the nation's only weekly podcast bringing reverse mortgage news to you, the mortgage professional. There are reverse mortgage calculators, but then there are reverse mortgage point-of-sale solutions. Lenderful Solutions helps you get more loans, retain more customers, and even make online applications a reality. To learn more, visit lenderfulsolutions.com.
Welcome to HECM World Weekly. I'm Gabrielle Hayen. This week, the Federal Reserve has held interest rates steady, but growing concerns around inflation suggest the outlook for mortgage rates may be getting more difficult and not easier. We're also looking at new housing data showing an interesting contradiction. American home prices have reached another record high, but homeowners are actually losing ground once inflation is taken into account. We'll look at why homeownership remains stagnant even as available homeowner inventory stays extremely tight, and within the reverse mortgage industry itself, proprietary products continue to gain ground, although the headline origination numbers only tell part of that story. Finally, we'll look at new research showing older Americans are becoming more defensive about retirement and why liquidity and downside protection could become an increasingly important part of the reverse mortgage conversation. There's plenty to unpack, so let's get into it. Let's start with the Federal Reserve. Policymakers voted this week to leave the federal funds rate unchanged at 3.5 to 3.75%. But perhaps more interesting than the decision itself was the disagreement behind it. The vote was 9-3, with Cleveland Fed President Beth Hammack, Dallas Fed President Lori Logan, and Minneapolis Fed President Neil Kashkari all voting for a quarter-point rate increase. It was the first time in almost a decade that 3 FOMC members dissented in favor of the same alternative rate decision. Federal Chairman Kevin Warsh welcomed the debate.
Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight. My view, which you've long heard, is that's the better way to get policy right. That's our North Star.
But financial markets were less reassured. Yields on 30-year government debt climbed to their highest level in nearly 2 decades following the decision and Warsh's press conference, while stocks also fell. The concern is inflation. Higher oil prices, new tariffs, heavy investment in AI infrastructure, and resilient consumer spending are all contributing to concerns that price pressures could remain elevated, and that potentially requires the Fed to raise rates later. President Donald Trump continues to push in the opposite direction. Speaking before the announcement, Trump praised Warsh, but criticized other members of the Fed board.
But costs are going down rapidly. And as soon as the war is over, you're going to see a big drop.
Are you worried that the Fed's going to hike rates to counter inflation?
A board. And Kevin's fantastic, but he's got a board, and the board members are very political, I would say. So, we fight our way through the race because we're doing so well. But no, he's got a board. He wants to do the right thing. I know what he wants to do. But you need the consent of some people that have perhaps bad intentions. Rates should be lowered. This country could be at 8%, 9%, 10%, 12% GDP. That's what it should be.
So what does all of this mean for housing? Mortgage rates averaged 6.58% last week, according to Freddie Mac. That's a significant reversal from earlier this year when mortgage rates briefly dipped below 6%. Of course, the Fed doesn't directly set mortgage rates, but mortgage pricing is heavily influenced by inflation expectations and longer-term Treasury yields. And that means hopes for substantially lower mortgage rates in the near term have taken another hit. For reverse mortgage professionals, there are 2 sides to this. Higher rates can reduce proceeds and make product economics more challenging, but persistent inflation and higher living costs can also put more pressure on older homeowners, particularly those who may be asset-rich through their home, but increasingly stretched when it comes to cash flow. And that brings us to this week's housing data. On paper, American homeowners became wealthier again in May. The FHFA reported national home prices increased 0.3% for the month and 2.2% compared with May last year. That took the FHFA National Home Price Index to another record high. But once inflation is taken into account, the picture changes. Inflation-adjusted home prices reportedly declined 2.3% year over year. That was the 9th consecutive annual decline in real terms. And the latest S&P Totality case, Schiller data, tells a very similar story. Its U.S. National Home Price Index recorded a 1.1% annual increase in May, but inflation was running at 4.2%. That means U.S. home values have now fallen in real terms for 12 consecutive months. There's another important part of this story, too. Housing markets are increasingly diverging depending on where you live. FHFA recorded annual price changes ranging from a 0.3% decline in the Pacific Division to a 4.5% increase in the Middle Atlantic. The Case-Shiller numbers showed an even bigger gap across major cities. Chicago was up 6.9% year over year, while Las Vegas was down 1.9%. And that matters for our industry. We've talked a lot recently on HECM World about the extraordinary amount of housing wealth held by older Americans. That wealth hasn't disappeared, but record home values don't necessarily mean that the purchasing power of that wealth is continuing to increase. If home values rise 1 or 2% while the cost of living rises 4%, the homeowner may be wealthier on paper, but not necessarily in real economic terms. It also means geography is becoming increasingly important when discussing home equity, principal limits, and retirement planning. The national housing equity story remains incredibly significant. It's just becoming much less uniform. And there's another piece of housing data this week that connects directly with that story. The Census Bureau's second quarter report put the national homeownership rate at 65%. That's unchanged from a year earlier. And at the same time, the homeowner vacancy rate was just 1.2%. So America isn't meaningfully adding homeowners, but very few existing homeowner-occupied homes are sitting vacant. That creates an interesting dynamic. Existing homeowners continue to control a scarce and valuable asset, while many prospective buyers remain unable to enter the market. And when we think specifically about older Americans, there's an obvious connection to aging in place. Older homeowners control an enormous share of America's housing stock. And if more of them choose or need to remain in their homes for longer, the question becomes how they can sustainably fund retirement while doing so. And that's where housing equity becomes much more than simply a measure of household wealth. It becomes a potential financial resource. And the products being developed to access that resource are changing quickly. We covered this story in more depth on HECM World earlier this week. New analysis from the Mortgage Bankers Association shows just how quickly proprietary reverse mortgages have expanded since the market contraction of 2023. According to MBA's analysis of HMDA data, proprietary products represented 22% of reverse mortgage originations in 2025. 2 years earlier, that figure was just 7%, and the growth rates are striking. HECM originations increased 4.7% in 2024 and just 0.7% in 2025. Proprietary reverse mortgage originations increased 81% and 118% respectively. So if we're simply counting loans, virtually all of the industry's recent growth has come from proprietary products. But there's an important qualification here. Units are only one way of measuring the reverse mortgage market. Dollar volume tells a different and considerably stronger story. Higher proprietary value and increase to the HECM maximum claim amount mean individual reverse mortgage balances can be larger. So relatively flat HECM unit production doesn't necessarily mean flat HECM dollar volume. And proprietary products demonstrate that distinction particularly clearly. They accounted for 22% of reverse mortgage units in 2025, but nearly 40% of total reverse mortgage origination volume by dollar amount. So there are really two legitimate ways to interpret what's happening. By units, HECM has been largely flat since the contraction of 2023, while proprietary products are driving growth. But by dollars originated, the overall reverse mortgage market presents a much stronger growth story, with both HECM and proprietary products benefiting from larger loan sizes. The growth of proprietary lending also raises an important question about product innovation. HECM remains a foundational reverse mortgage product, but private lenders have increasingly developed products that can address situations where the federal program doesn't necessarily fit, whether that's certain higher value homes, condominiums, qualification circumstances, or borrowers seeking greater proceeds. That doesn't mean proprietary products are universally better than HECM. It means the private market is increasingly finding ways to serve borrowers and scenarios that the existing HECM framework doesn't always accommodate. And that raises a bigger question for the industry and policymakers. Is HECM evolving quickly enough to meet the changing financial circumstances of today's older homeowners? You can read our full analysis of the MBA data at hecmworld.com. And finally, this week, some interesting retirement research that helps connect many of these themes. Analysis from the Center for Retirement Research found that economic and policy uncertainty is already changing the behavior of older investors. Among non-retired respondents, 21% had postponed retirement, 28% had increased their emergency savings, and 33% had shifted toward more conservative investments. Financial advisors were also feeling uncertain. More than 60% were concerned about a market decline and potential Social Security reductions, and 87% were worried about federal debt. For the reverse mortgage industry, there's an important signal here. What many older households appear to be seeking right now isn't necessarily another source of income. It's security, it's liquidity, and it's downside protection. That's a potentially important distinction in how the industry talks about housing wealth. A reverse mortgage doesn't necessarily have to be framed simply as a way of generating additional money to spend. For the appropriate borrower, access to home equity can potentially become one component of a broader retirement strategy, providing liquidity and reducing dependence on other assets during periods of economic or market stress. And there's another opportunity here. Financial advisors themselves are worried about markets, Social Security, and the broader economic outlook. Those advisors are also an important potential referral source for the reverse mortgage industry. If retirement planning is increasingly focused on resilience and managing uncertainty, then the enormous amount of wealth sitting inside clients' homes arguably deserves a bigger place in those conversations. And that's really the thread connecting this week's stories. America's housing wealth hasn't suddenly disappeared. Older homeowners are still in control of an extraordinary amount of equity, but the environment around that wealth is becoming more complicated. Inflation is eroding real home price growth. Higher rates are making borrowing more difficult, and homeownership remains stagnant while existing homeowners continue to control a scarce asset. Within our own industry, proprietary reverse mortgages are rapidly gaining share, while HECM unit production remains comparatively subdued. And older Americans themselves appear to be becoming more cautious about retirement. For the reverse mortgage industry, this opportunity is therefore bigger than simply talking about record home values. It's about understanding the role housing wealth can play in a changing retirement landscape and making sure that our products and conversations evolve with it. That's it for this week's HECM World Weekly. I'm Gabrielle Hayen. For reverse mortgage news, analysis, research, and industry insights, subscribe to this podcast and sign up at hecmworld.com so you don't miss a thing. And we'll see you again next week.